Okay, you have to accept that. And I heard there was some question about where the recordings are. Those are posted up. I think I'm caught up on that now. I want to make clear, guys, if there's a question, I do my best to get those up, but those are processed. I have to download them from Zoom, get them on my machine, and then I have to upload them to YouTube. And I have to do it that way. It's not like I can rely on somebody from Golden Gate to do that work for me, or the system does it automatically, as maybe is happening with some other classes you may be taking. I have to put those on YouTube because I'm making those available to you beyond the time of when the class is open. So I can't rely on the system to keep a class available for you. I have to go through that process, and that all falls directly on my plate. So I do my best to keep up with those. If I fall behind on those, you're gonna have to be patient and expect that I will get those up, which I do. But sometimes I fall behind. But I get email from the administrative folks saying, "Well, Warren, you're not posting your recordings." Well, yes, I am, but it might take a little while to do that. So from time to time, I might fall behind on that. Okay, good. But with all that, let's go ahead, and I'm going to put us in full screen, and let's talk about tonight's agenda. What I want to do is get through at least, well, hopefully the first 4 modules, although, as you know, I've already asked you to look at module 3 on your own. So our goal for tonight is to cover modules 1, 2, and 4, and maybe with some luck, being able to get into module 5, maybe wrap that up. I don't think we'll have time for 6 or 7 tonight. Okay, so that's the game plan. When we look at some of these areas, and there's a variety of areas in here, and they break these into 2 different chunks here, but we'll see that here, this part is fairly light, about 2 points. When we start getting into here, we start getting more into some techniques like regression analysis, high-low method, some of those things. And if you add those up, that does come to about 5 points on the exam. Okay, you start talking a little bit about, well, ratio. I've already asked you to look at that. You have to know every single ratio in that section. Okay, so if you haven't looked at that video, make sure you do that. Make sure you are comfortable with the flashcards that cover those ratios. If you see a ratio that's discussed in the lecture that isn't a flashcard for, I need you to make that flashcard, okay? Because there is a chance that you could get a task-based simulation on that material. I don't go through it with you because I'm of the opinion that there's very little light that I can shed on divide this by that, or add this to that in order to give you these ratios. But I do want you to be comfortable with those, because that will be potentially a task-based simulation. We'll talk about marginal analysis. Marginal analysis tends to be about 5 points on the exam. It gets a little annoying, to be honest with you, at some point, because at the end of the day, in textbooks anyway, the answer always is, and in exam type questions, the answer always is take the option that does what? Maximizes revenue, lowers expenses, maximizes profit. But we will see that there are some qualitative characteristics, considerations, probably a better word, that we want to consider when we make those, and we'll flashcard some of those sort of in a cost benefit analysis kind of approach that we take for a lot of those areas that we cover. When we get into budgeting, budgeting tends to be about a 5-point area. Okay, even though they've broken that into 2 separate topics, there are parts. It's about 5 points combined. And again, we may get through part 1 tonight, probably not part 2. I would highly doubt that. And then variance analysis, we will definitely push to next time. That is a 10-point area on the exam. And I'm going to sort of give you next time what I like to call the ninja approach to answering these questions, because if you try to do it the way the book shows you, you start to get pretty tangled up in some of the things that they're showing you there. I'm going to give you a very quick way to remember how to handle these ratio and get these 10 points. Okay, good. So that's sort of a sense as to where we're going with point values. So let's just go ahead and turn our attention to module 1 here. And we start talking about projection and forecasting techniques, and we'll get more into the definition between difference between a projection and a forecast here a little bit later. But let's just talk about sensitivity analysis, okay? In a sensitivity analysis, also called a what-if analysis, is a risk management tool that is used to test the effect of specific variables on profitability. Okay, so what happens if something changes? How will that change the profitability of the entity? Now, you can go ahead and flashcard that sensitivity analysis, also called what if, is focusing on how there will be an effect if different variables change over profitability. Now, they tell us here, we're going to flashcard this because this is sort of the, approach of risk rewards or, for and against, okay? And one of the biggest drawbacks of sensitivity analysis, and we're going to see in the example, is you make a change into one of the variables to see how it's going to affect profitability, but then the assumption is that other things don't change. Well, nothing in this world works that way. If you change one thing, then something else is going to change, right? So that's one of the sort of drawbacks. It's not very realistic often with sensitivity analysis, okay? So let's just go ahead and let's take a look at this example. And we have this sales for Besser Company are projected to be 100,000 with cost of goods sold of 60,000 and administrative expense of 25,000. The CFO has determined that the variability in sales has the biggest impact on profitability, and she wants to see what happens if we vary on either side of the point estimate, 25% plus or minus. So in order to estimate the change in operating income, the CFO assumes the cost of goods sold will constantly be 60% of sales. Again, seeing they're kind of building in some of the limitations of sensitivity analysis, that probably wouldn't be the fact that would stay static if you have a change of 25% either side on the sales. And then really the big drawback here of this assumption is that our general selling and administrative expenses will stay constant at 25,000. Think about that. If you increase sales, how are you increasing sales? Well, you maybe would be increasing sales by doing what? Incurring some additional advertising and whatnot, which this sensitivity analysis is not taking that into consideration, okay? So they ask us, hey, what's going to be the effect on profit, okay, if we have this variability plus or minus 25%? And so, starts to get sort of like no duh, kind of really, that's all there is to this. I mean, we gave it this funny name, this fancy name of sensitivity analysis, and all they do is put the plus or minus 25% on either side. They keep what? They keep the cost of goods sold at 60% of the sales, okay? And then again, this sort of real big, limitation here is they keep these general administrative expenses the same. And we came up with the variability and profitability based on the sensitivity of plus or minus 25%. Okay, question? Not very, stimulating, I know, but I've got you some of the key flashcards there on what the sensitivity analysis is all about. Okay, so let's go ahead and let's talk about scenario analysis. And we can prepare budget under different scenarios. And what we can do in this is come up with weighted totals for the different scenarios. We'll add those together and we'll come up with what is basically an expected amount of whatever our profitability or whatever it is we're trying to estimate being. In this case, I think it's going to be revenue that we're talking about, or sales. Okay, so what happens? They have three different scenarios. They have an optimistic one, they have a pessimistic one, and then they have here a most likely. Okay, and notice what they do is they assign percentages to each one of these likelihoods. Okay, so there's a 30% likelihood that we'll get a 5% sales growth, 20% likelihood that we will have a 5% decline, and then 50% that there will be no growth or decline. Things will just remain. So if the current sales is what, 40 million, okay, we do what? We go ahead and we apply the probabilities to each one of those: 0 growth, 5% decline, 5% increase, the appropriate percentages. And that means that we're thinking there's a chance that there will be a 0.5%, that's a 0.5% growth. And so what do? We take this current and we multiply that times the 1.005. That's the 0.5% part of it, right? And we're projecting that we're going to have sales next year of 40.2 million. Okay, so we basically come out with an expected growth rate here. And once we get that, then we can go ahead and apply that to the current situation to see where we land. Of course, it doesn't have to be growth. It could be decline, but it turns out when we did the numbers here, the chances were that we thought we'd have a 0.5% growth. Okay, good. Now we come over, and I think I mentioned regression analysis there with being part of maybe the part 2 material. It looks like it's here in part 1, which is fine. And most of this could just blend together and they end up putting it into 2 different segments because they're trying to have these bite-sized segments. Okay, but we talk about forecasting, and let's just go ahead and talk about forecasting. Okay, forecasting versus projection. Okay, so what happens? A forecast, and let me give you an example. A forecast says, let's say I have a loan, and I'm going to use that loan to open up an additional restaurant or something. I have the loan. I'm going to go ahead and I'm going to open up a restaurant or another restaurant of my chain of restaurants, whatever it is. Okay, so what happens? I have the loan and I have an expected course of action, which is I'm going to open up the restaurant. Okay. A projection has a hypothetical assumption in there. It says, if I get a loan, this is what I would do. I'd open up another restaurant, etc. Okay. Now, the reason I give that example, okay, is that projections are typically used internally because you're saying, if I get the loan, you haven't gone and got the loan yet. So they're either used internally or with parties negotiating directly. And in this example, that would be who? That would be the bank. Okay, I mean, obviously, if you're going to the bank to get a loan, then they're going to want to see, well, what are some projections of how things are going to look if we give you this loan, right? So even though they say internally, well, it could be external, but there's a direct discussion back and forth. If you give me this loan, this is what I'll do with it, right? Okay, now that is different than a forecast. A forecast says, hey, I already have the loan and I'm going to do this. I'm going to open this restaurant. Do you want to come along for the ride? Well, if that's the case, I might put out some sort of prospectus to the general public or something and want them to go ahead and come in and be part of this. Okay. Okay, good. So just go ahead and flashcard that forecasts can be used both internal and external, where projections are typically internal, or you can add that part with parties you're negotiating directly with. Okay, because it's not just limited to internal. Okay, good. Now, forecasting techniques can both be qualitative and quantitative. Okay, and let's just go ahead and start to look at some forecasting techniques down here. Let's just take a look at regression analysis. Okay, now what happens with regression analysis? Well, with regression analysis, okay, we're basically, I'm just going to draw a little graph here, okay? We're going to say with regression analysis that we have a dependent variable, say y up here, okay? And then we're going to say that we're going to have an independent variable, say x, okay? Now, what we will do is we will observe the movement in the y as the x moves. And we'll basically put these points into a regression analysis. And what regression analysis does is it comes along and it says, okay, you have a line that fits this scenario. You have a function that fits this scenario, something like this, okay? Or, I should probably have drawn that. There may be some fixed component, and then something like this, maybe there's a variable component as well. Okay, now if you notice, that line doesn't fit, it doesn't connect 2 points. Okay, but we do have various observations that are sort of lining up along that line. And regression analysis is a sophisticated tool, because what it does is it statistically says, well, this is the line that most likely describes what's going on here. And depending on the results of this regression analysis, we can tell you whether or not the independent variable and the dependent variables are correlated. Maybe they're not correlated. Are they positive correlated, the way I'm showing you here? Are they negative correlated? And it can help us to make some forecasts and projections of things that we think are going to happen. Okay. And the classic one for us accountants is what? The Y could be what? Total cost. The X could be what? The tech X could be units, something like maybe direct labor hours. As we incur direct labor hours, this is the way total what? Total, potentially total overhead costs move, okay, as direct labor moves. And then what? We would sit here and say that this would represent our variable cost, and this would represent our fixed cost, right? So you could do that with this, and you could use this regression analysis to help you come up with what you believe your predetermined overhead rate to be, okay? Now, you go ahead and you start to take a look on the next page, and they go ahead and they're putting this in the parlance, if you will, of regression analysis, okay? But if you take a look, our Y would be total overhead cost, the way I'm looking at this, because I am an accountant, equals what? Fixed cost plus my what? Plus my variable cost times, and in this case, the units might be what? Might be direct labor hours, right? Okay, and so we could put in observations of points over the course of a year, over the course of a couple years. And frankly, you can do this pretty easily in Excel. And what'll happen is you'll go ahead and you'll put those numbers into those observations in. These were my direct labor hours. These are my total overhead costs. And it'll tell you, this is basically the equation Y equals A plus BX, but it's total overhead costs, your fixed cost plus your variable cost times direct labor hours. And it'll tell you whether or not direct labor hours are positively correlating or pushing your total overhead costs. And if they are, then you found a good driver. If they're not, the analysis is telling you if it was negative or was close to zero, the analysis is telling you don't have a correlation here. You should probably look for another driver of your overhead costs, because direct labor hours ain't it. Okay. Okay. So we start to take a look, and they're telling us here that, so I've sort of already labeled it as such, but let's just take a look. Y are what? Are our total costs, maybe our total overhead costs. X would be the total activity. For example, what? In our little example, our direct labor hours, the little example I just gave you up there. The Y axis intercept, okay, is going to be, for example, what? Fixed costs, that's the A. And then the B here is going to be what? Is going to be, for example, our variable cost per unit. So all they did down here was kind of do the same thing that I did, right? You know, putting the numbers in the equation here. Okay, now they tell us, why should we care? And of course we care because what? Because the CPA exam might, you know, want you to predict costs, right? It's probably overhead costs that we're looking at. But if Y is total cost and X is the activity, one goal of regression analysis would be to direct total cost based on observed total activity. Okay, so that's why accountants care, and you care right now, because you're getting ready to take the BEC exam and you want to know how they're going to hit you up, right? Okay, now let's just go ahead and take a look and see how we would interpret. And we're going to look at two coefficients here. Okay, we're going to look at the coefficient of correlation, which is going to tell us how these two independent variable and dependent variable are correlated. And then we're going to look at another coefficient, which is the coefficient of determination, which will tell us how much of the movement in Y is explained by the movement in X. Okay, two correlations that we're looking at. I mean, coefficients, excuse me, that we're looking at here. Okay, so the first coefficient, the coefficient of correlation, measures the strength of the linear relationship between the independent variable and the dependent variable here. We call that R, okay? And so when we look, the range could be between between perfectly negatively or inversely correlated versus what? Perfectly positive correlation, okay? So what I want you to do is go ahead and just flashcard right here. What is the correlation between the independent and the dependent variable? Now I'm noticing, guys, they give you a straight line here. That is not the fixed cost line, okay? Because we know that fixed costs are fixed costs and they're gonna push up the total, right? What we're looking at is how does total cost move as the independent, how does the dependent variable move as the independent variable moves, okay? Now, if we have one, it is a perfectly positive correlation, okay? And I don't know, that means that the dependent variable and independent variable move together in the same direction, okay? As one increases, the other increases. Now, I'm thinking, how about temperature to swimming? What do they call them? Swimming holes, swimming center visits. I have a swimming center, you know, where I charge people.
Positive correlation.
Huh?
Positive correlation between the two.
Yeah, I'm on positive correlation. So I'm thinking that would be positive. Hey, as the weather goes up, we expect more people to seek swimming, right? If the weather is cold, nobody wants to go swimming. Okay. Okay, good. So what happens? We sit here and we say, if you have perfect inverse correlation, okay? And the one that I'm thinking of that comes to mind is what? Restaurant revenue during as COVID cases rises. More COVID cases, they start closing down the restaurants. Restaurant revenue is going to go down as the number of cases of COVID come out, right? No correlation says, hey, these things do not have any kind of effect on each other. Okay, so they are not related. And I'm thinking increase in dog bites to seaweed in the ocean. Hey, we've seen more seaweed in the ocean, but that doesn't increase dog bites or something. And why would it? Okay, and so these are the outcomes that you would look for with what? With one being the perfect positive, a negative one being a perfect opposite correlation or inverse correlation, and zero slope to this being no correlation, okay? Now, again, from an accountant standpoint, we are interested in how would we use it to project total cost? So when projecting total cost, the dependent variable as a function of the fixed cost, variable cost, and volume, which are the independent variables, the expectation, the correlation will be somewhere between what? 0 and 1. Now look, if it's 0, then we don't have a correlation. We're going to probably have to find another driver. But as it gets closer to 1, the more you think you have a nice fit to, the thing is fitting your expectations. Okay, now as I said, 2 correlations. The other is the correlation of determination. Okay, so now they sit there. Our second coefficient is the coefficient of determination, and they take that R and they square it. Okay, so they're telling you, hey, how much of the movement of the dependent variable is caused by the independent variable, and we square it because we don't want that negative in there, right? When we square it like that, it does what? It takes that negative and it would turn it into a positive. So that number will always be positive. Now you have to realize that that means that what? The inverse movement of Y is significantly caused by the, the movement of X. And of course, if the number is positive and you started out with a positive number, that means that most of the movement in the, that'll tell you to what degree the movement in the independent variables caused by the dependent variable. Okay, so go ahead and flashcard that, what R squared is, and it's a number between 0 and 1. Okay, and then let's just go ahead and take a look at the correlation of determination. Okay, so based on looking at 5 years of data on fixed cost and variable cost per unit, Raxen Inc. determined that it is fixed and variable cost, and the next year will be $16,000 and $450 per unit respectively. Racken has determined that the correlation coefficient, right, that's our first coefficient, the correlation coefficient between the independent and dependent variable is equal to 0.9. Okay, so we got a pretty nice fit. Most of the time you're not going to come out with a 1-to-1. I mean, nothing in life works that way, but 0.9 is pretty close. And then we go ahead and when we square that, okay, we end up with what? 0.81, which is telling us that 81% of the movement of Y here is caused by X. Question. Okay, good. Let's go ahead then and let's take a look at another method, which is
I got a super quick question. Are there any, to your knowledge, do they have any accounting programs that actually use regression in any way, in an auditing context? Because that seems like it'd be great.
I'm not aware of a specific accounting software, Eric, but Excel has this function set up in it pretty, I would think if you spend a little time with Excel and just reading up a little bit on how to do it, it's fairly straightforward. And what it does is it gives you nice readouts and it gives you some numbers. I think they call it the T variable. And depending on what that T variable ends up being, it tells you, hey, this thing is not correlated, step away from the analysis, or hey, these things are pretty well correlated, so you should continue on. And there's different things that they have there. So I would recommend that you just Google, and I'm not giving you a very specific answer to your question, but I think you would get a pretty specific answer to your question by just Googling using Excel for regression analysis. And I've had students in my managerial accounting class, I gave them extra credit for taking some points in an example that we looked at in the book, in my cost accounting class at San Francisco State some years back. And I gave them extra credit for doing that in Excel, and they handed that in, and they did a pretty nice job with that. So it's not horribly complicated, I don't think.
Eric, to answer your question, if you take the data analytics course, they actually go over a few really good softwares. I don't remember exactly, but it was more on the analytical side, but you could use it to any application for just large amounts of data.
Okay, good. Okay, any question? Any other question? Okay, but there are tools out there, and it's pretty widely accepted. Now, the thing about using regression analysis, although it's fairly sophisticated, it really depends on what you're trying to do with it, right? Because think about it. I could use, a linear equation, total cost, okay? Let's just do that. Total cost equals what? Equals variable cost times direct labor hours, and plus my fixed costs, whatever, and that's how I'm going to get my total. And I keep forgetting to put the OC in there, total overhead cost. You could do that, right? Okay. And then the thing is, well, what if I'm wrong? What if direct labor hours don't really correlate that well with it? Well, don't forget, guys, all that will do, because we're using this to come up with a predetermined overhead rate, all that will do is cause us to have an over or under applied overhead at the end of the year. And when we have over or under applied overhead, we just simply make a journal entry to fix that. If it's what? If it's under applied, we're going to have to debit cost of goods sold, and we're going to have to credit the overhead account, right? If it's over applied, what would you do? Credit cost of goods sold and debit the overhead accounts. So, I often tell my students, they're like, well, how come it's under over applied? Don't worry, I can fix that as an accountant. I can fix that with a pen. I just have to make a journal entry. to fix it. So it's not like a bridge falls down or something if we get this wrong. We just make an adjusting entry at the end of the year. Okay, so that's why we can sometimes consider a high-low method, which is less sophisticated than regression analysis. But if we're a little bit off, so what? We'll just make a adjusting entry for our overhead at the end of the year. Okay, so let's just go ahead and let's just take a look at how we would use the high-low method. And they're basically, and you just saw that, total cost, and I'm always thinking of it in terms of overhead costs because that's sort of where I would think you might want to use this. Total overhead costs equal what? Whatever my fixed overhead costs are, plus my what? Plus my variable cost times, and again, the units, which is probably a little bit of oversimplification, because you could have different drivers for your overhead costs. It really depends on what's driving it. I was on an assignment years ago with the GAO. There was an explosion at a rocket fuel plant. Now I'm here to tell you that when a rocket fuel plant catches on fire and starts exploding, it doesn't stop. So the thing exploded for like, an hour. Okay, and so the whole thing just got devastated. It turned out that there was one of only 2 plants in the entire country that produced, and I said it's a rocket fuel plant, what it produced was the oxidizer that makes the solid rocket fuel burn. Solid rocket fuel needs this oxidizer. It's called ammonium perchlorate to burn. And the reason it's important that you have solid rocket fuel is it's lighter. So that's why they got real nervous when North Korea developed solid rocket fuel, because the missiles can fly further once you're using this sort of solid fuel as opposed to liquid fuel, as you can imagine. So they have this oxidizer that they use to make the thing burn, and damn place it catches on fire into an oxidizer of rocket fuel. So the thing just blew up. It was horrific. It was in Henderson, Nevada. So it turns out that that was only one of 2 plants in the entire country that produced this oxidizer. So Congress was like, well, is the other one getting ready to blow up? What's going on? Do you see the same safety issues at the other one? So we started to look, and both of them were in Henderson, Nevada. Now, the reason they were both in Henderson, Nevada is you have what? Cheap source of electricity, because an electricity is a main component of producing this solid rocket fuel, however the science on that works. Well, that being the case, what happens is you want to put that somewhere where you can get a cheap source of electricity, and you can get a cheap source of electricity in Henderson, Nevada, in the Las Vegas area, because Hoover Dam's right there. You think Vegas leaves all those lights on because they want to look pretty? Yeah, they do, but they also have a cheap source of electricity there. So that's a long, overdrawn story to explain to you that you look for whatever the driver is of your overhead costs. In that case, the driver would have been what? Kilowatt hours of electricity. Okay, but often we see the direct labor hours is the one that we use. Okay, so when you look at this example using that high-low method, they sit here and they look at the units, the volume. This could be observations of direct labor hours. I can go back to that. And this could be my what? Total overhead cost that I observe over several months here. And they're doing 6 months worth, probably because they didn't want to have 12 months, quite frankly. And also, maybe you're doing this in June because you need to get ready to figure out what your predetermined overhead rate should be starting next year or something. You don't want to wait till the very end of the year. But with somebody mentioned the data analytics class, with these data analytics software, you may have observation points going back several years that you can pull into this analysis. Okay, but they go ahead and they look and they say, well, look, we have different points, just like we saw with the regression analysis, that are going to be observed that as one moves, this is how this one moves. But rather than use statistics to fit a line, what we do is we connect the highest and the lowest. And I know I squiggled my pen a little bit, but we connect the highest and the lowest just to sit there and see, okay, how do these guys line up if you just look at the high and the low? What's the equation that comes out of that? Okay, so when you looked at this set of observations, and guys, you always leverage off if the CPA exam gave you a question in which your units and costs didn't line up high, low, always look to the units to find your high and low, okay? Because it doesn't necessarily have to line up perfectly, because maybe this thing isn't quite perfectly fit the way we're talking about here, right? Okay, we're just drawing the picture between the line between these two. We're just assuming. So when I look here, they give me what? They give me a high. The high is 9550. I see the units there, 1,400 units. Again, I look at the units. I see the low is what? 1,000. And they give me this 8,450. Okay. Now I want to figure out what the variable costs are here. And so what am I going to do? Well, it's just like if you wanted to get the slope of a line, we could think of this as y equals mx plus b, just going back to basic algebra class. And m would be the slope, and m would be what? Would be y high minus y low divided by what? X high minus X low. Putting in the parlance of what we're looking at here, it could be what? It could be total cost high. Okay, so the variable cost would be total cost high minus total cost low. And then it would be what? And I'm assuming direct labor hours. So it would be direct labor hours high minus direct labor hours low, right? Okay. And so if you look at it from that standpoint, and you just go ahead and you pick up these numbers, now you're going to say what? 9,550 minus what? Minus 8,450, and that's going to be divided by 1,400 minus, and these of course are dollars up here, right? Direct labor hours in our little example, minus 1,000. Okay, and when you do that, you come up with what? You come up with, if you do the math on that, just drawing this line up here, you come up with your slope of that line, which is your variable cost, right? Is the slope there, which is 2.75. Now, once you have that, you can go ahead and you can pick the high or the low. Do you like to get high or do you like to get low? Okay, so I'm going to go ahead and I'm going to say, well, I want to get high. You could use either. Okay, but you go ahead and you say, well, look, when I'm at 1,400, okay, I have what? Total cost of 9,550. And if I take what? If I take 275 times what? Times the 1,400 units here. There's my variable cost. Well, if that's my variable cost and my total cost is what? 9,550, the difference must be my fixed cost. And you could either pick the high or the low. Now, you can't pick any other point. You got to pick the high and the low because you're saying that's my line, right? Okay, these other observations may not fit. So you pick either the high or the low. Either one of those are fine. And when you do, now you have your equation, which is your total cost is your fixed cost plus your variable cost per unit times the number of units. Okay. Now, what are you going to do with that? Let's say now, just kind of carrying that example a little bit further here. Let's say that we decided that our units were going to be 1,500 for the month of January or something like that. We wanted to predict the cost for that first month of January. Well, what would we do? We'd say, okay, 275 times what? Times, now we're doing our projection, aren't we? 1,500, okay, plus what? Plus the fixed cost, which we've determined to be 5,700, okay? And so that goes ahead and gives us a projection of what? 9,825, if I'm doing my math right. Okay. Now, If I wanted to come up with a predetermined overhead rate, what would I do? Let's say I needed a predetermined overhead rate that I would use to apply my cost to all my products, whatever, my jobs, if I'm using job order costing, whatever, over the course of the month where I'm using these 1,500 direct labor hours in our little example. How would I come up with a predetermined overhead rate? Michael, are you speaking to us? I saw your mouth moving, but I didn't hear anything.
No, I was talking to myself, trying to remember.
Oh, okay.
I got one suggestion. I think you could use a regression for that, actually.
Well, no, if I was going to use regression, then I would have used regression. This is a different method we're talking about here. If I was going to use regression, I'd use regression. I'm telling you that if I incur 1,500 direct labor hours, my total overhead cost would be 9,825. Is there an ability to come up with a predetermined overhead rate here?
You would want to divide your fixed cost over the 1,500 hours, right?
No. Well, yes, but not quite. I would take the 9,825, which is what I think my overhead cost is going to be at 1,500 direct labor hours, and I would divide it by what? By 1,500. That gives me something like 655 per direct labor hour. So every time a job or a product uses up direct labor hours, I multiply that by what? 655. I add that to my direct materials, my direct labor, and I know what that product cost me, right? Okay, now that may not be perfect. So what? I applied it at the end of the year. By the end of the year, I'm going to go ahead and I'm going to do what? Make an adjustment for under or applied overhead. Okay. Yes, you could have used regression analysis for that, but that would have given me a different equation. And at the end, whatever the total ends up being, I divide that by whatever the driver is, and that would be my predetermined overhead rate, right? But that's a different method. Okay. Okay, good. Now we come over and we talk about learning curve here, guys. And this is a little annoying because I don't know that the exam going to get all hopped up on learning curve. But what learning curve basically says, and you can flashcard, is as we get more experience with a certain process, we should become more efficient, right? That's what we mean by the learning curve, okay? And they tell us that the analysis is used to set standards, project costs, as variable cost per unit should decline with a steady, once a steady state period has been achieved. You can flashcard that. And we also say that in order for the learning curve, it has to be a repetitive process with no real breaks. In other words, you are routinely doing this thing in your company. You don't have 6-month intervals where you're not doing it. It's a continuous process. Okay. Now, what we are seeing here is these examples where they say, well, look, it takes us 50 hours to produce the first unit. If we have a 70% learning curve, estimate the average time for 2, 4, and so on units. So what is the average time it takes to produce 2? Well, if it took us, 50 hours to produce 1, and we have a 70% learning curve, then the average time to produce 2 should be 35 hours. And so on. If we're sitting there and we say, well, look, total time to produce 2 is 70 hours, and if we have a 70% learning curve, then what? Then it should take us to produce 4 units. It should take us 24.5 hours, and so on. Okay. Now, when we look at these examples, I'm not going to go through every single, iteration there, but when we look at these examples, what I want you to flashcard here, okay, what I want you to flashcard is the way to come up with these learning curves that they're giving us in the example is how long, I guess I should tell you what we're calculating. To calculate learning curve, that says to calculate learning curve. Okay, to calculate learning curve, how long would it take with the learning curve? I'm going to abbreviate that LC. How long would it take with the learning curve divided by what? How long without the learning curve? Okay, how long would it take to produce whatever the number of units they're telling you, usually 1 unit, with the learning curve versus how long without? Okay, so let's just take a look at that. And it takes Jones, okay, it takes Jones, let's try that formula. It takes Jones 50 hours to produce the first unit and 70 total hours to this is good kind of perverse, if you want to really, if you ask me, to produce the first 2 units. Okay, so what happens? Well, 70 total hours times 2, if what? If we have the, 70 total hours per 2, if we have the learning curve divided by what? What it would have taken us to produce 2 units if there were no learning curve, because it told us what, 50? Okay, and so they come up with the 70% learning curve that way. Okay, so I think the takeaway from all this, in the event, other than, what we kind of said is just sort of the general principle of learning curve, if they were to ask you to calculate it, which I don't know that you'll see a lot of questions like that even in your homework. I doubt that you'll see one on your exam, but have that flashcard just in case you get one question or something stupid on that. Okay, with all that, let's go ahead and let's work our first multiple choice question for tonight. Okay, let's go ahead and take a look at this one, guys, and forgive me, I had to address something there, but about 3 minutes. We probably should be able to answer this in about a minute. Okay, but good. Looks like just about everybody got this right. And let's just go ahead and take a look at the options here. And they say that the coefficient of determination, and they help us out really by telling us that that's the R squared in a multiple regression, is the percentage of variation in the independent variable explained by the variation in the dependent variable. And I don't even know exactly what that is. Okay. B, the percentage of variation in the dependent variable explained by the variation in the independent variable. And yeah, okay, that's the one. The first one is flipped, right? We expect that the variation of the dependent variable to be explained by variation of the independent variable. The first one is the opposite of that. That's nonsense. C, the measure of proximity of actual points to the estimated data points. That really, guys, is what? That's R. That's telling you how close those points are to that estimated, slope that you were giving this equation. And then D, the coefficient of independent variable divided by the standard error or regression coefficient. I have no idea what that is. I don't know why anybody would have picked that. We said nothing like that. I don't even know what that is. That's a drunk statistician talking. Okay. Okay, good. Let's go ahead and let's try question 2. Okay, let's go ahead and let's take a look at this one, guys. Looks like most of us have had a chance to look at it. Okay, we got a pretty good, well, 67%, but I see no reason why this couldn't be 100%. So I'm not sure what some of the errors were that about 3 of us made. But let's go ahead and let's just take a look at that. And we have what? We have, and if you're missed it just because you randomly guessed, you're wasting your time, okay? Because you really should be trying these, okay? But if you put some numbers in that didn't fit in, that's completely understandable. Let's go ahead and talk about this. So we have what? We are trying to figure out our estimate for our materials handling costs and the number of kilos handled versus the cost. So they're setting this up as what? Almost like an overhead rate, aren't they? Okay, what is your cost for your materials handling? So we go ahead and we say, well, our high, and in this case, we don't have to sift through a bunch of highs and lows. They only gave us two. So we have no choice but what? To pick the two high and low observations here. And they didn't call it high-low method, but that's what it was. And then we go ahead and we divide that by what? The 80,000 minus the 60,000. Okay, and when you do, you come up with what? You come up with a variable cost of what? Of $1.40 per kilo. Okay, now to get the fixed cost, you can go high or you can go low. Since the book in the previous example that we looked at went high, let's go low just so we can see that we can get the answer with either the high or the low. So we have what? Total cost of 132, and we're going to what? We're going to subtract from that the $1.40, the variable cost of total cost minus variable cost is going to equal, that's his variable cost, is going to equal fixed cost, right? So the $1.40, and since we're picking at the low, we put the 60,000 units in there. And when we do the math on that now, we get what? We get 48,000. Looking at my notes, okay? So now we can go ahead and we can say, well, look, our total cost then, okay, which is what they're asking us to estimate here, is going to be the $1.40 times, and they're asking me what would it be for 75,000 units plus the total cost that I just figured out of 48,000. And you stick all the numbers in that little analysis equation, and you get what, 153,000, I guess? The correct answer. Okay. Now, let me ask you this. What would be the predetermined overhead rate here? How would you set that up?
You would divide the total cost of 153,000 by 75,000, which
Good.
would be $2.04.
Good. Okay. I don't know that the question will go that far, but I'm just trying to tell you because, well, why are we doing this? Why are we trying to estimate this total cost of how, when the independent variable kilos, how does the cost move? Well, we probably want to know how to charge each job for this material handling activity, right? Okay. Okay, good. Then the heavier the job, the more overhead you apply. If the job's a little lighter, doesn't require as much materials, less overhead is going to be allocated to, going to be applied to it, right? Okay, good. Let's go ahead and see if we can get through. I think we can get through variables versus versus absorption here, okay, before the break. So let's just take a look at that. Okay, now we have two ways that we're going to array our financial statement, our income statement, essentially. Okay, so we have the absorption approach. Okay, absorption approach, okay, is GAAP. It's for what? External reporting. Okay, the contribution approach is not GAAP, but it is what? Better for internal analysis. Okay, so what we're going to do is we're going to see how these two approaches differ, because if we're trying to make certain internal analysis, it turns out that it benefits us to separate our variable costs from our fixed costs, so that we can start to make decisions such as break-even analysis, some of these other things that we're going to be looking at here. Even when we get into our discussion of differential reporting, it's going to be helpful to tease out our costs in the variable and fixed. GAAP says, no, we don't want to do that. We don't have to call out fixed versus variable. We just want to see what is the operating income. Okay, so what happens? They tell us that the absorption approach is required for US GAAP and does not segregate fixed and variable costs. Okay, that's how we prepare our income statement. So when you look at the equation, and not equation, but the format of the income statement, okay, you're very well acquainted with at this stage of your career, of your development, we have what? We have revenue less cost of goods sold. Okay, cost of goods sold are going to contain my product cost, aren't they? My product costs, what am I called product costs?
Direct labor, direct materials, and overhead.
Good, plus manufacturing overhead, right?
Okay.
Okay, good, that's my product cost. And guys, it is both fixed and variable. Okay, okay, good. That difference gives us gross margin. And then we have our operating expenses, and our operating expenses product cost.
No, they're period costs.
Good. I mean, by the definition, period, right? Cost means that they, I mean, I should say expense, they are what? Period cost. So period costs do what? They go straight to the income statement, right? How about my product costs? Where do they go?
Balance sheet.
First, good, excellent. First, they go to the balance sheet, right, in the form of inventory. And then they go to the income statement as cost of goods sold when they are sold. Okay. Okay, good. And then they say that that difference is net income, but you'll also see it sometimes called operating income. In fact, usually they'll call it operating income because what we generally want to track operating income. Net income is affected by things that are outside of the normal operations. And if we're calling them operating expenses, it probably should be operating income, not net income. Okay. Now, under the contribution approach, okay, and let's just take a look at that. The contribution approach to the income statement uses variable costing, also called direct costing, okay? And it does not represent generally accepted accounting principles, but the contribution approach is extremely useful, as I've said, for internal decision processes. I want you to flashcard that, guys, because they give you a lot of different names there, you know. Okay, you can call me contribution approach, you can call me variables costing, you can call me direct costing. Okay, so since it's going ahead and giving you all these different names, like the guy, hey, my name's John, but you can call me Jerry, you can call me Jack, and you can call me Joe. Okay, well, if that's the case, then you need a flashcard as all the different names this person goes by, right? Okay, so what happens? You sit there and sorry, guys. There used to be a character, a comedy character years ago where the guy said, you can call me Jay, or you can call me Ray, or you can call me Ray Jr., but she doesn't have to call me Mr. He had this whole routine anyway, so that's where that comes from. So when you got these things that have all these different ways of calling it out, you better flashcard that, okay? Now, When we deal with the contribution approach, we have revenue, which that's the same under both methods. That wouldn't change under either method. But now we take variable costs, okay? And it is both what? Product and what? Period cost. Now for the product cost though, it's the product cost for what? For units sold. Okay, so the product costs still do what? They still rest on the balance sheet. Okay, the variable product costs still rest on the balance sheet until what? Until the units are sold, and then they hit this contribution income statement. And then period costs are what? Are going to be taken out regardless in the period, right? They never hit the balance sheet at all, okay? Now, for our fixed cost, okay, our fixed costs are subtracted, and it's what? It's all fixed cost. All fixed costs. I don't care. All fixed costs are going to be taken out under the contribution approach. We take all the fixed costs, both product and period. Everything is subtracted, okay? Okay, now, this is the very important point here now, okay? And you take a look, and they tell us down here on the next page, absorption versus, because that's where the exam's going to hit you, okay? And the difference between the absorption approach and the contribution approach is the treatment of what? Of the fixed factory overhead, okay? The fixed factory overhead, what's going to happen? Those are always going to be what? Are always going to be treated as a expense for the period. Selling an administrative cost or what? Selling an administrative cost are what? Are always going to be subtracted as expense under both methods, right? So it's what? It's the difference is how do we treat those what? Those fixed product costs? Because the variable product costs, they pretty much do the same thing. They go from the balance sheet to the income statement, but we're teasing out the fixed what? The fixed overhead cost, and we're doing what? We're subtracting all of those, right? Every single time. So the difference is how do we treat the what? The fixed overhead costs. Variable overhead costs and then direct labor and direct material are variable. They're treated up there, and we have to wait till we sell the units to take those costs. Okay. Okay, good. Now you come over, and I ask you to flashcard that difference because that's really what it's all about. Okay. And then let's go ahead and let's just take a look. And they tell us, as we've already stated, that under the absorption approach, what happens? All fixed overhead cost is treated as a product cost and is included in inventory values. And then what? Until they are actually sold. So cost of goods sold then includes both fixed and variable costs once the units are sold. Under the contribution approach, okay, variable costing, also known as variable costing, all fixed overhead costs are treated as a period cost and is expensed in the period incurred. Inventory values, therefore, only include the variable manufacturing costs. So cost of goods sold includes only variable manufacturing costs. And of course, you have to sell those units for them to hit the income statement, the contribution approach income statement anyway, okay? So when you look, guys, as to what is a product cost, what is a period cost, notice that what? The big difference is how do we treat the fixed manufacturing overhead, right? Okay, it is a period cost under variables versus absorption, okay? Now, what is the effect on income, okay? And so let's just go ahead and take a look. And you can see down here the effect on income, okay? And if production is greater than sales, what's going to happen? Then I'm going to have some fixed manufacturing overhead still sitting on the balance sheet under absorption that would be what? Hitting the income statement under variables slash contribution reporting, okay? So if that's the case, what happens? I'm going to call it abs. I'll call it absorption. Just write it out, John. Absorption will have what? Have a greater operating income, a greater operating income. Let me write my greater sign here. Then what? Then variables operating income. Because what's happening? We're sitting there and we're doing what? We're holding costs on the balance sheet, the fixed manufacturing overhead anyway. We're holding those on the balance sheet for absorption. Meanwhile, we're immediately taking them to the income statement for contribution / variables, right? Okay. Now, let's just come down and let's say sales are greater than production. If sales are greater than production, now what's happening? Now, my absorption operating income is going to be less than my variables operating income, and therefore net income, okay? Then my variables operating income, because what's happening? For variables, I already took the fixed manufacturing overhead expense in the period it was incurred. For absorption, as I'm doing what? Is I'm taking items out of inventory and bringing them to the income statement. They're reducing my what? My contribution margin, whatever, and creating a smaller operating income. Well, they leave out if there is no change in inventory there, okay? I don't know why they left that out, but it's okay because it's down here. If there is no change in inventory, then what? They'll have the same, okay? So increase in inventory, absorptions, net / operating income is bigger. And if we're talking about decrease in inventory, then variables has the bigger. You can just flashcard it right there. Okay. Now, they talk about the benefits and limitations to each method, guys. And let's just take a look at that. I don't know, guys. Just flashcard this. Benefits and limitations, just flashcard benefits, limitations. I don't know what to tell you. I mean, I know what this all means, but I don't feel like reading it because it's like, whatever. There's nothing earth-shattering there that I really need to explain. So for the sake of time, okay, I'm just going to ask you to flashcard the benefits versus the limitations. Okay, and you can just flashcard the part that I'm highlighting here for you. I don't think there's really any need in me calling this stuff out because it's sort of self-explanatory. But flashcard, and the reason I'm asking to flashcard these is what? The exam likes to ask benefit versus limitations, for and against, essay question, potentially, right, in the BC exam. So just flashcard those. Okay, okay, good. Come over and let's stop and let's take the break. I'm showing 6:19 and so 6:20. So let's go ahead and let's come back to this at 6:30. Okay, and we'll pick up here where we left off with break-even analysis. I'm going to pause the recording. Somebody remind me if I need to. So I started up again. Zoom the recording and let's go ahead and start to take a look at break-even analysis. Okay, now what happens? Break-even analysis, basically, we're going to see that we're going to be using the contribution margin When we look at contribution margin, we're going to see the contribution margin is going to be our sales price. And typically, guys, they give you the sales price per unit. Okay, if they give you the total sales price and the total variable cost, then you would just have to simply divide that difference by the units. But if typically they'll give it to you by unit, but sales price per unit minus variable cost per unit, okay, is going to give us contribution margin. And we call it contribution margin because the contribution will first, F-I-R-S-T, John, cover fixed cost. And then anything that's left over will go towards what? Will go towards profit. Okay, and I'm not sure that that's the best graphic has ever been produced, but I'm running out of space there, but it does what? First, contribution margin has to cover fixed cost, and then if something's left over, it contributes to what? To the profit of the company, okay? Now, if you think about this then, if you were to take the sales price per unit, okay, times what? Times whatever your break even, your contribution margin per unit, okay, times your break even units, then you would set that equal to what? Fixed cost. And then if you do the algebra on that, you simply do what? To get your break even in units, you simply take your total fixed cost divided by the contribution margin. Okay. I like to set it up like this because that way, if I run into a CPA exam question that tells me, say what the break even units is, and wants me to calculate the fixed costs, then I can do that, right? Because they could do that because they want to just see if you understand the relationship. Often, they will be looking for this sort of unknown here. The break-even units is typically, real life, what they'd be looking for. But what happens on the exam, because it is an exam still, they may sit there and say, well, your fixed costs are this, your contribution margin is that. So what's the break-even in units? But they might say your break-even units is this, your contribution margin is that. What the fixed cost? Okay, you need to know how to put that together. Okay, but let's go ahead and let's just take a look at this, and we have what? They give us the fact pattern already. Let's go back up to the fact pattern here. And the sales price per unit is what? Is 125. Variable cost is 50. So we have a contribution margin per unit of $75. And then they also give me contribution margin ratio. Contribution margin ratio is my contribution margin divided by my sales price. In other words, 60% of every sales dollar would go to cover a variable cost, right? Okay. Okay, good. Guys, if you don't know how to calculate contribution margin, I guess you could flashcard it there. Okay. Now they tell us here that the fixed costs are 150, and then they start giving us information about desired profit and potential sales units and so on. I'm not going to highlight that because we're just going to see how we'll plug these things in as we go along and try to calculate some of these other things. Okay, but let's just go ahead and let's just take a look. And what do? And again, guys, I'm going to just go ahead and do this one more time like this. Contribution margin per unit, okay, just using it the way I wrote it up there, is what? Contribution margin per unit is 75. Just how they calculate that, variable cost, sales price minus variable cost, times the break-even units, which is what we're trying to find here. It has to equal fixed costs, and they told us up there that the fixed cost was what? 150. So they go ahead and they do the math, and to break even, we need what? We need 2,000 units. Okay. Okay, good. So what happens? That's it. To cover those costs, we need 2,000 units. Now, if we want that break-even point in dollars, okay, there's a couple of different ways you can do that. You could simply take the break-even in units and multiply it by what? The sales price per unit. Okay, and you can flashcard that, but that's what they did. The sales price per unit was what? Was 125 times the 2,000 units gave us the 250. Okay, now another way to quickly get the answer in dollars, okay, is to use the contribution margin ratio. Now, contribution margin ratio, okay, contribution margin ratio times what? Times the break even now in sales dollars has to equal fixed cost, doesn't it? Is another way to look at it. So all they do here, and you can flashcard it here, all they do here is they take the total fixed cost and divide it by the contribution margin ratio. Okay, so guys, it's two, you're gonna get the same answer, aren't you? Okay, two ways to get the same answer. You got to know both though, because what if the exam just gives you the contribution margin ratio? Then you're not going to be able to do it by getting the units and then multiplying it by the sales price. Okay, so that's all they did here. They took that contribution margin ratio, they divided it by the the fixed cost, and they got the same answers we got when we multiplied the units times the sales price. Okay, now look. Nobody is on this call tonight, and we're losing people as we go, which I have already observed who is and who isn't here. So people that are dropping off the call will get an email from me as to what are you doing. Okay. Nobody is here tonight because they want to break even. Everybody wants to make a profit in life, right? Okay, so all you need to do to figure out what the number of units are to come up with a certain profit is simply do what? Simply add the profit that you desire to the fixed cost and divide that by the contribution margin per unit, and that will tell you how many units you need to sell to meet a certain target profit. Okay, now you go on, and they said they wanted, and again, I didn't highlight everything up there because I knew they would repeat it here. They have the profit that you want, 150 plus 60,000 divided by the contribution margin per unit. Obviously, you have to sell more units if you want a profit now. It's 2,800, right? Okay, and again, you could go ahead and do that by taking the contribution margin ratio. What was the one that I don't like the way they do this? Yeah, this where they tried to turn it into dollars, and I'm like, why are they doing this? Okay, this is kind of silly over here. The way I would do the sales in dollars, okay, is I would flashcard, take your what? Take your sales price per unit and multiply it times what? Times your target profit units. And that will give you what? That will give you the sales dollars you need. Okay, so if you look at the example that they just gave us, it was what, 2,800 units to meet that target profit times what? Times the 125, which is the sales price per unit, gave us the 350,000, which is the answer that they're giving to us here by coming up with this overly complicated blah plus blah plus blah plus blah. I don't know why you would do it like that. Okay. Okay, good. Now, if you want to use the contribution margin ratio approach, again, simply what? Add, it's the same thing as the break even when you're using the contribution margin ratio approach to turn it into sales dollars, not sales dollars, not units, right? But sales dollars. You simply add the pre-tax profit to the numerator. Okay. Okay, so nothing terribly complicated here, guys, and that's what they did here. They just simply added that 60,000 target profit to the $150,000 fixed cost, and they got the same answer that we got by multiplying, and I think it's better to multiply the sales price times the target profit units, which is the way I showed you how to do that. Okay. Okay, good. Now you come over and you say, well, can you predict profit now based on volume? Okay, so they say, well, what if the company sells 2,500 units? Well, now you sit there and you say, well, look, it was 2,000 to break even. So I've got what? I've got an extra 500 units that I am thinking I'm going to sell. So the 500 units times my contribution margin, because at 2,000 I covered my fixed cost. Anything over that goes towards, as we said, profit, right? Okay, so you should just take that additional amount over the break even, and that's how you would get to predicting profit based on the assumed level. Okay. Okay, estimating selling prices based on a certain assumed volume. Okay, so if you want to get the sales price per unit, take your what? Fixed cost plus your variable cost plus whatever you want that pre-tax profit to be, divide that by the number of units you think you can sell, and that will tell you what your sales price per unit needs to be. Okay. Now, there's also this notion of margin of safety. Okay. And what margin of safety says is, hey, am I just barely making it over my fixed cost, or do I got a nice chunk over my fixed cost? Because if I'm going to sit here and I'm going to just barely make it over a fixed cost, there's a chance that what? I'm going to slip down and I'm now not even going to break even, right? Okay, so we'd like to see what kind of cushion we have. We call that the margin of safety. It's basically whatever I've predicted my total sales dollars will be minus my break even sales will give me my margin of safety. And if you want the margin of safety percentage, it's going to be whatever the margin of safety was that you calculated up there, divided by my total sales dollars, and that's going to give me a nice percentage there. And I, of course, want that percentage to be a little bigger. I'm not trying to insult anyone's intelligence here, guys, by showing you, kind of the break-even chart, but make sure you're comfortable with this in case they were to give you a multiple choice question where they showed you a chart and gave you some references there and said, okay, where's the break-even area? What's the break-even point? Where's the, profit part, etc. Okay, I don't think you need me to walk you through the way this thing works. Okay. Okay, good. Now you come over and let's take a look at target costing. And with target costing, we don't mean the department store target. Okay, we mean target cost. And what you would do is you would figure out what the market price would be minus based on whatever your required profit is. Okay, and so you can go ahead and flashcard that. What can I sell it for? What's my required profit? And so now I have a target cost. Now, some implications of target costing, and let's go ahead and let's start to flashcard some of these. Okay, the implications compromise, I should say, quality, and that you're sitting there saying, well, I want to reduce costs because I want to make sure I'm trying to cover that profit, and this is the market price. So now you're using cheaper goods rather than trying to, basically see if you can maybe bring that market price that you can charge up or something like that, okay, through better advertising or whatever, right? Firms competing in this type of environment incur increased downstream costs, okay, as I'm mentioning, such as advertising, that sort of thing, okay. Increased complexity for cost measurement. Now how we measure cost starts to become what? Very critical, because we know we have to meet that cost. And so maybe we better start implementing some activity-based costing. It's going to give us a better precision as to what our costs actually are. And then product redesign may be redesigned to provide for the reduction of cost through the life cycle of the product. They say referred to as the Keynesian method, whoever, I don't know who these people are. You know, they have a lot of these business models are named after people that have been dead for 100 years now. So if you need to flashcard, you know, go ahead and flashcard that. Hopefully they won't ask you what's the Keynesian model, but have that on a flashcard. Okay. Okay, good. So let's go ahead and let's take a look. And we've got the flashcards here, okay, that I want here. But let's go ahead and let's take a look at a couple of multiple choice questions. Okay, good, guys. Looks like most of us have had a chance to look at this one. So let's take a look. And pretty good results here. Just about everybody got this one right. And we kind of mentioned relevant range last time. That means, well, we're not going to have to add another factory building or something. And break-even analysis assumes that regardless of the number of units, the variable costs per unit are going to be unchanged. It's going to be 240, whatever we've said per unit. Okay, you know, the only problem I have with this question, total fixed cost or non-linear. And I guess something's something's linear if it's a straight line. I mean, to me, linear means one moves one way and it moves the other. That's linear. Whereas fixed costs to me, are not linear. They're just a straight line. But okay, whatever. I'm probably getting overly analytical on this. Okay. Okay, good. Let's go ahead and let's take a look at this next one. Okay, guys, I'm giving you a little more time with this one, beyond the 2 minutes that I generally give. I'll give 3 minutes on this one, so you got about 30 seconds left. Okay, looks like we might be having a little trouble with this one. I've got 8 folks responding, so it looks like there might be 3 of us that are having a little trouble, but I want to go ahead and move us forward and we'll look at it together. Most of us got it right, okay, that we're able to answer it. The answer here is B, okay, but let's just go ahead and let's go through this one together. Now, I think what was tricky about this question is they kind of threw in there under the variable costing approach. Meanwhile, contribution margin is contribution margin. I mean, that's what variable costing does, is it shows the contribution margin, because then we can use that to do these various break-even analysis and stuff that we've been talking about. Okay, so it wasn't particularly important that you knew the difference between variable versus absorption. When you see that phrase, maybe that's where you kind of got hung up. You just need to know, how do you calculate the contribution margin? And it's what? It's sales price minus what? Minus variable cost. So I guess I better take the sales price. And I guess I better start what? Subtracting everything that's a variable cost. So open up your mics, folks. Is direct material variable cost?
Yes.
Yep.
Yeah, it is. Huh? Yeah, right. Is direct labor a variable cost?
Yep.
Yes.
Yep, got to subtract that. Is variable manufacturing overhead a variable cost? Yes, it is. Is variable selling and administrative a variable cost? Obviously, it is, right? Okay, so you go ahead and you subtract that. So you get all those variable costs, they called them out for us very nicely, and you get a contribution margin per unit here, right? Of what? $40 per unit. Did I do my math right? Okay. Now, here's where this might get a little bit tricky. Remember, to get the contribution margin, it's the actual number of units sold, because the units that aren't sold that were produced, even under the variable costings approach, still sit on the balance sheet, don't they? So to get the correct answer here, you had to pick up what? You had to pick up the numbers of units sold times the 4,500. And that's what gave us the 180. Was there a choice that contemplated the units produced? I don't think so, right?
No,
So,
that would have been 200,000.
yeah, so they didn't even try to pull you in on that, right? Okay, but it's important. They could have done that. You got to pick up the units sold. Okay, good. Let's go ahead and let's try this one. And this one is, I think, a really helpful question. Okay, so I'm going to give you some time on this one. Okay, guys, we're at 2 minutes. I'm gonna give you 30 more seconds. Okay, I'm gonna go ahead and end the poll. And again, we've got a couple of folks that are having trouble with some of these, I think, because we're not getting the responses. And we're at 57%. So let's just take a look at this. This takes a little while, I think, to get used to these questions, but they say at the end of the first year of operations, we have 2,000 units of inventory on hand. Well, when we start operations, what? We have 0 units. If we have 2,000 on hand, that means my inventory increased 2,000 units. Now, realizing that is slightly helpful, but not so much, because they tell me that absorption is going to be more than variables. So they've told me that already. If we had higher, lower, then that would be more valuable information. Okay, but since we increased 2,000 units, you stop there and you think about that. You say, well, we've increased 2,000 units, and what is the difference between the two methods? The difference is, how do we treat the fixed manufacturing cost? Under absorption, we don't take those until we sell it. Under variables, we take it immediately. So the fixed manufacturing overhead for these extra 2,000 units has already hit the variables income statement. It won't hit the absorption income statement, okay, until those units are actually sold, right? So we do what? If they tell us that the fixed manufacturing overhead costs are $30 per unit, that $30 times those 2,000 units already hit the contribution margin approach, the variables approach, the direct costing approach. Remember, it has a bunch of different names. So the answer here is what? Is 60,000? Question. Okay, good. Let's take a look at this next one. Okay, we're at 2 minutes. You guys all right? I've got 3 people responding. What's the matter?
Having a little trouble.
More steps on this one.
Okay. Okay, well, let's go ahead then. That's all right. Let's go through this together. I mean, the few folks, you know, we got 80% correct, which that's good, but we only had 5 people responding. So let's go ahead and let's take a look at this one. And what happens? We're sitting here and they want the break even. Okay, now we know that break even is going to be what? Contribution margin per unit times what? Times the break even units, which is what they're asking us for here, right? Okay, that's what they want us to figure out. And that has to equal fixed cost. Okay, so we sit here and we say, well, can I get the contribution margin from what's here? And I take a look and I say, well, if my sales price is $20, then I have to subtract what? Sales price minus variable cost. So I just have to figure out my variable cost. Is manufacturing overhead a variable cost? Well, let me start a little higher. Are prime cost variable cost? Prime
Yes.
cost are direct materials, direct labor, aren't they? Okay, so I have to subtract that. We learned that in a previous section. Okay. Are variable manufacturing overhead variable? Yes. Are what? Are variable selling and administrative variable?
Yeah.
Yes. Okay. So you have to subtract that. So I'm able to come up with this what? $12 contribution margin per unit number. Okay. So I'm just going to plug that in down here. Now I start looking around and I'm like, well, what are my fixed cost here? Okay. So then where it got tricky is you had to sit there and say, well, look, if the annual sales are 900,000 and the sales price per unit is what? $20, then they must be anticipating that they're going to sell what? They're going to sell 450,000 units. I mean, not 450,000, but what, 45,000 units? With me so far, Donald? Hello?
I know.
Kind of. Well, if I'm going to sell 900,000 units and I have a selling price of $20 per unit, how will I get there unless I sell 45,000 units?
Yeah, all right. Yeah, that makes sense.
Yeah. Okay, good. Now to get the fixed cost, then I simply need to what? Get my fixed cost per unit, which is my manufacturing overhead and my selling administrative. They're telling me those are fixed costs. I add those together, that's $10, isn't it? So my fixed costs are $10 per unit. So this is telling me that my fixed costs are going to be 450,000. And so if I know that my fixed costs are 450,000, and I know that my contribution margin per unit is $12, then I simply take the 450,000 and I divide it by the $12, don't I? Which is how we came up with these 37,500 units. Question? Okay, good. All right, let's go ahead then and get into our, and as I've said, this module, I want you to look at it on your own. I don't want to get into sitting here and talking to you about, you know, taking numbers off of a financial statement and then, you know, dividing current assets by current liabilities to come up with, you know, the working capital, or I should say current ratio. I think you can look at that on your own. Make sure, though, that you pick up the flashcards that are either provided, or if you have a ratio that's discussed here for which you don't have a flashcard, I need you to go ahead and make the flashcard for one of these ratios. Okay. Okay, good. Let's come over then and see where that next module starts. which is going to be marginal analysis. Okay, now it gets a little annoying in a textbook situation, an academic endeavor like the CPA exam is, because, you know, the answer always is pick the option that maximizes profits, lowers costs, right? In reality, you may not do it in practice. You may not actually do that because there are other implications, and they do mention those other implications. But the problems always seem to turn out, yeah, just go ahead and do this. And when they ask about the other implications, they kind of ask about them in a standalone question. Okay. Now, what the CPA exam likes to do, though, is they'll give you a listing of costs in the question, and some of the costs may be relevant to the decision, where others may be irrelevant to the decision. Okay, so we need to think about which costs would be relevant to the decision. Okay, so you come down here and we talk about incremental cost and opportunity cost. These are considered relevant. Okay, so just go ahead and flashcard that these are both relevant costs, and let's go ahead and include on our flashcard what the nature of the incremental costs are. And the incremental costs, they tell us here, are all variable costs and any avoidable fixed costs associated with the decision. And we're going to look at some examples with that. Opportunity costs, okay, are also relevant to the decision, and flashcards specifically what we mean by, so I say flashcard that they're relevant, or you can make that one flashcard, which costs are relevant, put the definitions on there as well. But I think it's better to maybe do 3 flashcards. What are relevant, incremental, opportunity. What are incremental costs? What are opportunity costs? And opportunity costs now are costs that you basically will, will forego because of the option that you've chosen. Okay, so if you choose to develop another product, then you use up some, factory capacity to do that. The opportunity cost is the contribution margin that you lost, for example, by picking up this other product option. Okay, those are considered opportunity costs. Now you come over, and I think cost of foregoing, the next best alternative is probably a good phrase there. Okay, now you come over and they talk about opportunity costs, and opportunity costs relate to special device that is necessary. Costs associated with alternative uses of plant space are relevant, and that's a good example there. Now, irrelevant costs, okay, and irrelevant costs should be ignored in marginal cost analysis, and really our irrelevant cost is our sunk costs. If we have already spent something, it is not relevant to the decision because that money is spent, therefore it is not relevant. Okay, flashcard that. For example, if somebody walked up to you and said, hey, look, I want you to be my next action hero in my next movie or something like that, and I'm going to pay you, $1 million per movie, and you sit there and say, geez, well, I've already paid this much for my education, so I don't want to do that. No, what you've paid already for your education is not relevant to that decision, right? Okay, good. Now we come over and let's take a look at capacity issues. Okay, let's just go ahead and take a look at some capacity issues that we want to determine. And when we look at capacity issues, okay, if we have special orders, which is where we are here, special orders, and we have fixed costs are generally not relevant to these decisions unless the special order will change fixed costs, but really we're looking at presumed excess capacity. Okay, if we have presumed excess capacity, then the special order should be accepted if the selling price per unit is greater than the variable cost per unit, because we're not going to have to what, incur any opportunity costs. We're not going to have to give up any factory capacity, right? Okay, so we're at presumed excess capacity. If we are at what? Full capacity, that means there is no excess capacity. Okay, if there is no excess capacity, then what? Then we have to consider the opportunity cost, which is the contribution margin that is lost because we have accepted what this special order to produce something else means we have to give up whatever we were producing before. And if we give that up, we lose its contribution margin. Okay, so let's just take a look at a couple examples, guys, and I think that it'll become pretty clear as to how we'll treat these. So let's say we're looking here and they say that you can sell this thing for $150 per unit. And then they start giving me what? They start giving me the cost associated with these. And I'm going to go ahead and accept this if what? If the amount that I can sell it for is more than the incremental cost here, right? So what happens? I have this $20 direct material, that's an incremental cost. I have the direct labor, okay? I have what? I have the variable manufacturing overhead, so that is an incremental cost. And then I have what? Is the fixed manufacturing cost going to change?
No.
No, it won't change as a result of this. How about shipping and handling? Yeah, I'm going to have to incur that now if I pick up these additional items. How about fixed selling costs? That's not going to change. The fixed cost won't change. So I add all that up and that gives me $50. So I have to sell this thing for more than $50, which is the answer here, in order to start to make a profit. Okay. Now in this question on this deal, they didn't ask me, well, how much more profit do you want to make? Let's say I wanted to make $3,000 more profit. And they're telling me that the special order is for what? 1,000 more units. Okay, so if I want to make $3,000 profit, what would I do? I would divide that 3,000 by the 1,000 units. That gives me what? $3 per unit. So I'm going to ask for what? $53 per unit for this particular thing. This question didn't get into all that, but that would be the way I would do that, because I'd sit there and say, well, okay, if I want to make $3,000 extra profit on this deal, I better sell these things for $53. Okay. Now you look at this and you say, well, hell, John, we're selling them for $150. Why would we start selling them for $53? Well, you know, maybe this person is coming in with a pretty big order that nobody else comes in with, so we can offer them a special price, right? Okay. Now you come over and you take a look, and let's say now, instead of us having excess capacity, okay, we're sitting here, same fact pattern, but now we assume that we're operating at full capacity. And the next best alternative is generating a $10,000 contribution margin. Now, we would still need to sell at least for what? $50 to cover the incremental cost that we've talked about. But now we have to bring in these opportunity costs. And since we're giving up what? A $10,000 contribution margin, and we're having to give up 1,000 units to give us room to sell the 1,000 units, then in reality, we're giving up what? A contribution margin per unit of $10. So we would have to at least sell these for what? $60. And then we would probably sit there and say, well, but we probably want to make a little more profit on this, because why go through all this just to end up right back where we were, right? Okay. Now, there are strategic factors that need to be considered. And as I said, when you look at some of these questions in your homework, it gets a little annoying because they always decide to do it. For example, okay, sell them for $53. That's fine. Meanwhile, the public starts hearing that we're selling it to this person for $53 when we're selling it for $150. In fact, this person may start competing with us somewhere in the market, right? Okay. So, you know, you have to think about that kind of stuff. For example, will it affect our regular price? Possibility of future sales to this customer, okay, what pricing the special order, income taxes, okay, machinery going to start to break down, all of those things, you know, you can flashcard that. Okay, now make versus buy is similar to the consideration of our getting a special order, okay. And it could also be referred to as insourcing versus outsourcing. So why don't you flashcard that in case they throw those terms on you. Okay. And again, we consider it, do we have excess capacity or do we have no excess capacity? And let's take a look. If there is excess capacity, the cost of making the product internally is the cost that will be avoided or saved if the product is not made. That is the maximum outside purchase price. Flashcard that. If there is no excess capacity, then the cost of making the product internally is the cost that will be avoided if the product is not made, plus the opportunity cost associated with the decision, which typically is going to be what? The contribution margin that is lost from the products that we were being able to produce, and now we can't produce those anymore because we've exceeded our capacity. Okay, so let's just go ahead and let's take a look at this question here, this example here. And we have 20,000 units, okay, and the product costs are as follows. And an outside manufacturer has come to us, okay, and says that they can sell us the part for $5. We have excess capacity, so we don't have to worry about opportunity costs here, right? Okay. And the $10,000 factory floor supervisor salary is the only fixed cost that will be eliminated. Okay, so you start looking at these numbers and they give us, you know, the per unit and then the total cost, etc. But we have the 10,000, the 40,000, the variable manufacturing overhead of 20,000, and we have what? We have the avoidable fixed. Now notice a bunch of the fixed overhead costs are going to stay. So what happens? The total relevant cost is 80,000. We divide that by what? By the number of units. That's $44, excuse me, per unit that it's costing us. And you could look right there and say, well, hang on a minute. Now what? The outside person was going to charge us $5, so we should continue to make that internally, right? Okay. Okay, good. Now you come over and you take a look at some of the strategic factors here, and let's go ahead and flashcard some of those, okay? And when we produce the product, when we buy the product, we can't control the quality as much. Other warranties, risk associated with outsourcing, the most efficient use of the entity's resources, etc. So you can go ahead and flashcard that. Now, we've talked about some of these terms, guys, in another class, joint cost, separable cost, etc. Okay, and joint costs are sunk costs now. We're telling you that the joint costs are sunk costs and are not part of the decision as to whether to process further. Separable costs, remember, I think we used the example of shoes, right? We had running shoes and basketball shoes, and there are some costs like the cost of rubber and cloth or whatever that are the same, okay, that you can't distinguish the two up to a point the split off. Then at the split off, you start having separable costs, and separable costs are relevant to the decision and we want to say, hey, do we want to sell this now, these items now, or do we want to continue to process them because we think we're going to be able to make some money if we continue to process them? So you take a look, and they tell us the decision on whether to sell the split off is made by comparing the incremental cost and the incremental revenue generated after split off. And let's just flashcard what we're supposed to do. If the incremental revenue exceeds the incremental cost, we should consider the organization should process further, right? If the incremental costs exceed the incremental revenue, the organization should sell at the split off point. And of course, that's assuming that we have something that we can sell at the split off point. I mean, if it's junk at that point, no one's going to buy it anyway. Okay. Okay, good. Now we continue this discussion as to what costs are relevant in a decision when we start talking about keeping or dropping a segment. Okay, and let's just take a look at the decision factors here. And a firm should compare the fixed costs that can be avoided if the segment is dropped to the contribution margin that will be lost if the segment is dropped. Okay, and let's flashcard what we're supposed to do here. Keep the segment if the loss contribution margin exceeds the avoidable fixed cost. Okay, drop the segment if the contribution margin loss is less than the avoidable cost. Okay, so you take a look and what happens. They give us these different contribution margins, and they all have a pretty decent contribution margin. They all have a positive contribution. I don't know if it's decent, but they all have a positive contribution margin. And then we have the fixed cost per unit here, per segment here of 20,000. Now, when you look, you're saying, maybe we should get rid of conch because what? Because conch is a negative operating income. Okay, now they take a look here and they tell us that they kind of jump to the solution, but you wouldn't be able to get to the solution based on the information they give you. So they're kind of giving the solution while they're providing additional information. But it says if conch chowder fixed costs are unavoidable, then they'll be incurred even if the conch chowder is eliminated. So what's happening? We're giving away a contribution margin of 15,000. Meanwhile, we have what? No reduction in fixed cost. So we're giving away 15,000 of contribution margin for no reason. We haven't lost any of the fixed costs. In fact, if you look, that's exactly what happened. The operating income was reduced by the contribution margin of this conch because we got rid of it and got no reduction in fixed costs at all. Okay, so we should keep conch. Okay, good. Now you come over and you take a look at this next example, or same fact pattern, but now assume that 16,000 of the fixed cost would be eliminated. Well, if that's the case, and what? Conch only had a contribution margin of 15, yeah, we absolutely should get rid of it, right? Because now we're sitting here and saying, well, hey, we saved fixed cost of 15, and you know, we saved fixed cost of 16, excuse me, and we only gave up a contribution margin of 15. Okay. Now, again, you know, there are strategic factors there. For example, if we're going to start laying off folks, okay, we're going to start being Musk or something and start laying off everybody, then at that point, there might be some morale issues, etc., that we might want to consider. Okay, and so you can go ahead and flashcard some of the strategic factors that you would want to think about. Complementary character of the products, relationship. Okay, gee, you know, if you get rid of ice cream sandwiches, everyone likes to, you know, have the ice cream sandwich with our cookies or something. Now we'll start losing sales of cookies, which might be a problem, whatever. Now I made everybody hungry, right? Okay. Okay, good. Let's go ahead, guys, and let's try a couple of multiple choice questions. Okay, guys, we're coming up on 2 minutes, so let's go ahead and let's take a look at this one. And most of us got this right, 75% anyway. Okay, a couple of us wanted some of the other choices, which I'm not exactly sure. Well, I think I might be able to figure out how that went in, how maybe you got some of these higher numbers. So let me ask you, are fixed costs ever a consideration here?
No,
No. Okay, so you can immediately say, hey, I don't care what the fixed cost is. I'm worried about incremental costs, which are my variable costs, the 50,000. The fixed cost is a sunk cost. It's not considered relevant to the decision. So I have that 50,000. Now I look and I see that what? They have a 12,000 capacity and what? They're producing 10,000. And they're only going to get 1,000 different, 1,000 additional, I should say, circuits. So, hey, I don't have to worry about opportunity costs, which are relevant, right? So I go ahead and I take that 50,000 and I divide it by these additional 1,000 units, and I would have to sell these for what? For more than the correct answer here, which most of us got, which is the $5. Okay. Now let's go ahead and let's do this next one. Okay. And when you look at this next one, notice, guys, that what? Same fixed cost burden. Okay. Same variable cost. So I know that's relevant to the decision. So it's the 50,000 divided by what? Divided by, and again, it's still the additional 1,000 units. Okay. So that's going to give me, and I know it's got to be 50, not 50, but $5. Okay. So I look, and just from having read the previous question, I can get rid of A. Okay. But then they tell me that what? They're at 10,000 unit capacity. So I do need to consider what? Any opportunity costs. So I look, and they start to give me that information. Danforth and explored other alternatives known, and the next best alternative would produce a $2,000 contribution margin for this 1,000 unit run. So now I have to do what? take the 2,000, divide that by what, the 1,000 units, and I need to consider that I could have made what, this $2 per unit. Okay, so I would have to sell, am I selling or am I buying here?
Professor, are we so dividing it by the 1,000? They're trying to do the run of, or the 10,000 unit capacity for that $5 up top?
The 1,000, because I can sell 1,000 units and generate a $2,000 contribution margin. So that's $2 per unit, right?
But that's the $5, right? So wouldn't that be 50,000 divided by 1,000 equals 50?
50,000.
Divided by 1,000 is 50.
50,000 divided by, oh, I'm sorry, thank you. Divided by 10,000, you're saying.
Oh,
I did that. I
okay.
made that same mistake up here. Yeah, you're right.
All right, I just want to make sure.
Yeah, divided by 10,000. Thank you. Yeah, you're right. Divided by 10,000. That's where you got the 5 in both cases, right? And then the 1,000 units divided by the 2,000. That's correct. Is the $2, right? Sam?
Yeah.
Yeah. Okay. Okay, good. Yeah, thank you. I said 1,000. I should have said 10,000. And that gives me what? That gives me the 7,000. 7. Question. Okay, guys. I'm going to stop there. Not that our next area is really, really hard, but it requires a level of concentration that is probably not the best thing at this point in time for us. Okay, so we're going to see that we start talking about the budgeting. It's about reading carefully and following the directions. This area has more to do with reading comprehension than it does accounting. Okay, so what we will do is we will put this off until next time. I think you've got plenty of work for the first 4 modules here, and then we'll wrap up the last 3 modules next time. I don't think we'll get to chapter 5 next time, but we'll just keep pushing forward to try to make up for some lost time here. Okay. Okay, guys, if there are no questions, then I will see you on next Tuesday and we'll go from there. Okay.
Thank you.
Thank you. Have a
Thanks,
good night.
Professor.
All right, guys.
Thanks, Professor.
Good night.
Professor, I had a quick question.
Yeah, sure, Michael. Let me stop the recording.
Okay.
Just because you probably don't need it right now. But let me stop the recording.